Let's start with the jobs numbers that came out at the very end of the week. I saw person after person say they're just perplexing because it really missed on the headline number, but there was some good numbers below that. The participation rate was up, the unemployment rate was down. How do you as an economist interpret these numbers?
No one can be sure. There are two surveys, David. There's an establishment survey and there's a survey where they talk to people, and they're very sharply divergent this month. The establishment survey looks weak. The people survey looks super strong. If you take the average of them, which I think is a reasonable procedure for 1 month, you get an overall pretty strong number. So I read this as strong. I think the single most important number in the thing is that the unemployment rate is way down on rising labor force participation. That is, the unemployment rate is down and job creation is even stronger than suggested by the unemployment rate. So I read this as consistent with the picture that we've got an economy moving towards overheating, with the benefits that means for disadvantaged workers, but with the risks that go with inflation.
Okay, so let's pick up on the overheating. We had a pretty important development this week as the chair of the Fed, Jay Powell, testified up in Congress and basically said, you know what, it's more pervasive, inflation is, and it's more widespread than I had thought, and therefore we're going to have to consider at least moving up the time of the taper, something you've been arguing for. From listening to Jay Powell this week, do you think he gets it?
I was glad to see his testimony. I was glad to see him advocate retiring the word transitory from the inflation discussion. I wish it wasn't necessary, but given reality, I'm glad about what the chairman is saying. Here's what I think he needs to recognize next. If you look at what is in many ways the simplest indicator of the posture of monetary policy, where is the real interest rate over the next 1 year, as inferred from market inflation expectations and market interest rates, that number is at its lowest ever. That number is now way below -3%, closer to -4%. That is not a tenable place for enduring monetary policy to be. So I'd like to see him signal that there is no reason at all for us to be engaged in continuing QE and mortgage-backed securities, that there's no reason why we shouldn't very rapidly end QE altogether, that we need to start moving in the way we do when inflation is well above target. I'd be signaling 4 rate increases next year with two-sided uncertainty, depending on how the inflation figures work out. That will be a jolt, but a jolt is what is required to restore credibility, given how much monetary policy has lagged.
Larry, let's talk about that jolt, as you refer to it. Some months ago, you said your concern about the Fed is if they waited too late, if they were too dovish on this, they would have to take action that actually could tip us into a recession. Do we still have that danger? And is 4 interest rate hikes next year likely to tip us into recession?
I think 4 interest rate hikes next year are less likely to tip us into recession than 8 interest rate hikes the next year. And so I think we have got to get ahead of the curve rather than be behind the curve with respect to inflation risks. Look, I'm not saying we should lock into 4 inflation risks. I said we should be signaling that as a very plausible possibility. You know, if you look at every business cycle since the 1950s, the Fed funds rate has never peaked below 2.5%. Now we're looking at a situation we didn't have in the vast majority of those business cycles, where we're coming into it with 1-year inflation rates above 5. So if anything, that 2.5% figure is too low, and markets aren't pricing anything like that. So I still think we've got some substantial distance to go in terms of signaling the Fed's resolve. And I think the evidence is that when you signal more and your credibility is greater, you, in the end, find it easier than when you sacrifice your credibility and have to do even more to regain credibility. That was the lesson of the mistakes of the 1960s and 1970s.
Larry, one big piece of news was obviously Jay Powell's testimony talking about expediting the tapering of the bond purchase. Another big development, obviously, that happened over this last week is Omicron, something there's a lot we don't know about still. How does Omicron potentially factor into decisions about monetary policy at this point?
David, let me first say that I am very concerned. Here's the point that I think is not in the discussion, but should be much more active in the discussion. I can't contribute anything to the resolving the uncertainty about just how serious Omicron is. But what I can say is this: Omicron was a vastly larger mutation than anyone expected. The fact that we got such a vastly larger mutation, whether this one was benign or proves to be heavily malign, tells us that this virus is much more mutable than we had previously expected. It also means that in the future, we've got two different jumping off points for mutation that are very different. The original virus that we had and this new very large mutation. And so the prospect for mutation going forward that is damaging is far greater than we thought about or could have imagined as likely 3 weeks ago. And for that reason, I think we need all to just up our thinking around Omicron. It means that the global health effort needs to be very substantially stepped up if we are going to address this in a satisfactory way. It means that there needs to be much more capacity developed to not just provide vaccines to other countries, but to get jabs into arms. None of us are safe anywhere until this is under control everywhere, and the global effort needs to be ramped up. And I'd have to make the judgment that those in financial markets need to be aware that the range of possible scenarios is going to go up. With this news of increased mutation potential, there becomes a real possibility that this is not going to be a transient, but that we are going to be dealing with this kind of world for a number of years to come.
Yeah, it's sad, but I'm afraid all too true. Larry, finally, just briefly here at the end, we like to end with an outrage of the week. What's your outrage of the week? And a very eventful week, I must say.
I mean, my outrage is my discovery, probably too late, that the legislation that's working its way through the Congress in pursuit of green objectives has put in other objectives so strongly that if you buy an electric car with a union, you get a far larger credit than if you buy one without a union. And that seems to me to be exactly the kind of special interest measure that will compromise our achieving vital environmental objectives. And so I was sorry to see it.